Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market overview, macro data, megacaps, and tech divergence. This video presents a direct informational narration of the source document. So, looking at August 6, 2026, we've got a pretty quiet trading day on our hands. Volume is definitely shrinking, but underneath that, we're seeing rising oil prices and a real spike in the 10-year Treasury yield, mostly driven by hawkish Fed expectations.
Okay, let's dive into this agenda. We're going to follow a macro to micro funnel here, starting with broad economic data and zooming way down into specific high-growth market movers. We'll hit macro trends in job data, Google's AI infrastructure debt, and Microsoft's technical resistance. Then we'll shift gears into the SpaceX lockup expiration, check out an incredible cloud software divergence, and wrap it all up with Uber's business transition. Section 1. Macro Trends and Job Data. Transitioning right into the macro layer, let's look at the July Challenger job cuts data, which surprisingly just hit a 2-year low.
The exact number of announced job cuts came in at 33,429. To put that into perspective, that's a solid 27% drop from the previous month and a massive 46% drop year over year.
Breaking that down by sector from the source, tech took the biggest hit with 9,867 cuts. Finance followed with 3,157, and the government sector saw 2,962. Interestingly, AI drove 24% of the layoffs this year, with total projected cuts for 2026 expected to hit 149,023.
Wrapping up the macro side, initial jobless claims actually rose to 199,000, but they crucially remained below the expected 201,000 mark. Meanwhile, the 4-week moving average dropped to 198,800, and continuing claims rose just slightly to 1.801 million.
Section 2. Google's AI infrastructure debt. Let's shift gears into the megacap layer. We've got news about a key scientist leaving Google, but even more importantly, we're seeing some continuous debt issuance.
So why exactly is Google issuing $25 billion in debt when their free cash flow is already positive? Well, they filed to issue these bonds with maturities ranging anywhere from 2 to 40 years, specifically to fund the sheer massive capital expenditures required for the AI infrastructure race.
Basically, the market is betting that future AI monetization is going to outpace these borrowing costs. Looking at the timeline here, big tech free cash flow bottoms out in 2026, with many actually turning negative. But 2027 is the turning point, where it broadly turns positive, leading to accelerating growth in 2028. This return to robust free cash flow should trigger some major, sustained stock performance by mid to late 2027.
For Google's objective technical setup, the area between $300 and the current market price is considered a staggered entry zone. This is entirely based on a 2027 forward valuation floor sitting at $297. Section 3. Microsoft's technical resistance. Moving over to Microsoft, it's worth noting they don't actually need to issue debt like their peers to fund capital expenditures, but they are absolutely facing some significant technical headwinds right now. So, the crucial point is that Microsoft's recent upward movement occurred on incredibly low volume. That indicates a distinct lack of strong buyers, creating a really tough critical resistance zone between $498 and $516, which is just full of significant overhead supply. Right now, Microsoft's chart is showing bearish divergence and overbought signals. As defined here, a bearish divergence is a technical signal where the price hits a new high, but momentum indicators fail to follow suit. Because of this, a natural technical pullback to the $469 to $498 support level is likely necessary before any successful breakout can happen. Section 4. SpaceX lockup expiration. Now we're shifting further down the funnel into high beta names, zeroing in on SpaceX's performance during its very first lockup expiration day. Mapping out this lockup timeline, the IPO price was set at $135. During the initial unlock, we saw a quick dip followed by an impressive 6% rally on heavy volume. That lighter-than-expected selling pressure strongly suggests that institutional buyers are quietly accumulating shares below that $135 mark. Keep an eye out because the next big unlock is scheduled for August 20th and 21st. Looking closely at options pricing for that August 21st expiration, it actually implies a 16% volatility swing. That means the stock could either retest the $100 floor on the downside or rally all the way back toward the $135 IPO price on the upside.
Section 5. Cloud Software Divergence. Now, what's really interesting about this slide is the dramatic, totally unpredictable market divergence we're seeing between cloud software peers, Net and DDOG.
Just contrast the fates of these two overvalued companies post-earnings. Net beat earnings, raised their guidance, and surged 16% on pure positive sentiment. DDOG, on the other hand, also beat earnings, but reported a slight, almost microscopic slowdown in its growth rate. As a result, they were punished severely and plummeted 19%. As the source states, betting on earnings is a 50-50 coin toss and a long-term negative return endeavor. You have to monitor the technicals. There is strong technical support for Net at $263 to $283, while DDOG's technical floor sits a bit lower, between $219 and $236. Section 6. Uber's Business Transition. For our final segment, let's unpack Uber's current fundamental transition phase and how it's actively reshaping their balance sheet. The source breaks Uber's strategy down into 3 distinct steps. Step 1, they're deliberately sacrificing short-term margins and profits to fund broader business expansion. Step 2, they have to navigate through negative growth in 2026. And Step 3, the payoff, returning to positive profit growth in 2027.
Looking at the technical parameters provided, a breakout above $76.50 validates this transition strategy. Conversely, a breakdown below the $60 level implies a multi-year delay in profitability.
Ultimately, persistently low overall market volume right now limits broader trading developments.